Hello and welcome to The Explainer. Today, we're diving into a really fascinating investment strategy, one that promises to be simple, but also delivers some pretty powerful results. We're going to unpack Joel Greenblatt's famous magic formula, and more importantly, see how it actually holds up in the unique world of the Indian market. So let's just get right to the big question, the one that everyone's thinking. Is there really a simple, data-driven formula that can consistently beat the market? I mean, it sounds almost too good to be true, right? But stick with me, because the results we're about to look at might just change your mind.
And here it is. This is the number that gets everyone's attention. A compounded annual growth rate of 19.8% over 10 years. That's what the magic formula, adapted for India, has delivered. And I know the first question on your mind is, how? Now, to put that 19.8% in perspective, look at this. Over the last decade, the magic formula didn't just squeak by the market, it blew past both the Nifty 50 and even the broader Nifty 500. We're not talking about a small win here. Over time, that kind of outperformance makes a massive, massive difference to your portfolio. So, what's the magic behind these incredible numbers? Well, spoiler alert, it isn't really magic at all. It's actually a very disciplined strategy from the legendary investor Joel Greenblatt. And it's all built on two classic timeless investing ideas. At its heart, the magic formula is just a systematic, numbers-based approach with a very simple goal: to find great businesses that are on sale. You can think of it like a smart, methodical way to hunt for top-notch companies that the market, for one reason or another, has temporarily overlooked. And it all comes down to these two pillars. First, it looks for quality, which it measures with something called return on capital. This basically just asks, how good is this business at turning every rupee it has into more rupees of profit? Second, it looks for value, measured by earnings yield. This asks, okay, great business, but is it cheap? The whole point of the formula is that you have to get both. And here's the real genius behind it. This systematic approach, well, it takes us out of the equation. It removes all the emotion, all the gut feelings. It stops us from doing what we so often do, chasing hot stocks or panic selling when things get scary. It's all about following a process, not trying to predict the future.
Okay, but here's a crucial point. You can't just copy-paste Greenblatt's original American formula and expect it to work in India. Our market is different, the data is different, even the accounting is different. So to make this thing work here, a few key tweaks are absolutely non-negotiable. So here are the key adaptations for India. For quality, we use return on equity, or ROE, which is just a more reliable metric here. We also set a minimum company size of 1,000 crores just to make sure we're dealing with stocks you can actually buy and sell easily. Critically, we exclude sectors like banking and finance because their books are just a different beast altogether. And finally, we use what's called trailing 12 months, or TTM data, to get the most up-to-date picture and smooth out any weird seasonal blips.
Okay, so the theory makes sense, but how do you actually do it? How do you put this into practice? Let's walk through the exact steps you would take to build your own magic formula portfolio. Using a tool like screener.in, it's pretty much a four-step dance. First, you define your universe, filter for size, some basic financial health checks. Second, you rank all those companies by quality, from highest ROE to lowest. Third, you take that exact same list and re-rank it based on value, from highest earnings yield to lowest. And finally, you just add the two ranks together. The companies with the lowest combined score are your winners. They are the best combination of quality and value. And what's so amazing is how this acts as a powerful filter. You start with this huge universe of maybe 500 or more investable companies, and this process just systematically cuts through all that noise, leaving you with a focused, manageable list of just 25 to 35 candidates. That's the real power here. Now, finding the stocks is only step one. How you build the portfolio is just as important. The model suggests you hold about 20 to 30 stocks and, crucially, you give them all equal weight. This stops you from favoring one over another. You only rebalance once a year to keep things simple and low cost, and you put a cap on any single sector to make sure you're not putting all your eggs in one basket. So we've gone through the theory, the tweaks for India, and the step-by-step process. Let's circle all the way back to the performance and see what actually happened when these rules were put to the test in the Indian market over the last decade.
When you look at the year-by-year numbers, a clear pattern emerges. This formula beat the Nifty 50 in a whopping 8 out of the last 10 years. You see some massive wins, like in 2017, but, and this is so important, look at 2015. It underperformed. This is not some get-rich-quick scheme. It has down years. Its true strength isn't winning every single year. It's that powerful, long-term average. And because the formula is laser-focused on quality and value, it naturally tends to find companies in certain parts of the market. Over the last decade, it's consistently gravitated towards high-quality sectors like IT, consumer goods, and healthcare. And as we know, those have been fantastic places to be invested. And hey, this isn't just about abstract numbers. The formula has a real track record of finding absolute powerhouse companies at just the right moment. I mean, it highlighted a quality leader like Asian Paints when it was available at a fair price. It picked up the tech giant TCS when its valuation was perfectly reasonable. It even found Bajaj Finance during its early high-growth phase, long before its stock went into the stratosphere. And this really brings us to what might be the single most important lesson of all. You have to be patient. This strategy can and absolutely will go through periods where it lags the market, maybe for a year, maybe even 2. The magic part only really happens if you have the discipline to stick with the plan long enough for that value to be recognized. So that leaves us with one final thought to chew on. The numbers are incredibly compelling, and the logic is refreshingly simple. But is the real magic in the specific math of ROE and earnings yield? Or is it in having the systematic discipline to follow a proven process, through the good years and the bad, and take your own emotions out of one of the most emotional games there is? Something to think about. Thanks for joining the Explain.